From New York City for our viewers worldwide, I'm Dani Burguer in for Jonathan Farrow. Your last trading day and another disruptive piece of data. Too hot PPI sends yields backing up to their highest level of the year with stock futures lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, the latest inflation data coming in hot, sending futures lower and yields higher as traders start dialing back their rate cut bets yet again. We begin with the big issue, putting a bow on a busy week of economic data.
The confluence of data are all telling you this economy has more resilience. How much is reasonable to think about the Federal Reserve cutting interest rates? You know, we began the year with the market anticipating 5. We pushed a little bit beyond that. The market's going to have to come into being bounded from below by 3. And then the question becomes, is it 3 or is it less than 3?
Let's get right into it. Joining us to discuss is Aberdeen's Luke Hickmore and BlackRock's Amanda Lynham. Great to speak with you both. So here's what we got about 30 minutes ago. PPI coming in at 0.9% year over year. The expectation was for 0.6%. Bond yields back up. We're looking at a gain of about 10 basis points on the front end. Luke, let me kick it off with you. We were able to look through that CPI data. We bounced back from that. We didn't seem to care about weak retail sales. Will the market be able to look through this latest round of too hot PPI data?
Probably. I know it's a bit hedging there, Dani, but every time we think we're at the end of the inflation run and it's come down to the point where the Fed can move, we get a surprise. In some ways, it's fairly normal. Inflation tends to do this after it's come off a big hike and it's come down a long way. We get these little ripples and waves of inflation coming back. So it may be still too early to tell, but I think over a medium to longer term, yes, we should look through it. By the end of 2025, we've probably got 2 percentage points off the Fed rate. And we may just be arguing about small things here, whether it's 3 or 4 this year. It may not matter by the time we get to the end of next year.
We go to the land of nitpicking, I guess, in that scenario. Amanda, what say you? Are we going to be able to look through this figure?
Good morning, Dani. Thank you for having me. I think to a certain extent, the market should stay attuned for real-time changes in the pattern. One of the key risks, I think, for risk assets is a sustained reacceleration in inflation. That's not our base case, but it's a risk that we're monitoring. I don't think we can extrapolate a few recent data points, specifically perhaps maybe the January data in the CPI print was impacted by seasonality. So I think we need to look, as Fed Speak has also alluded to, at the totality of the data and the mosaic of the data. That being said, the main takeaway from our perspective is that it emboldens the Fed's patient stance. And our base case remains for the first rate cut to happen in the second half of 2024. And I think the recent data from our perspective just removes a sense of urgency for swift, significant near-term rate cuts. And I think that's consistent with the data that we've seen this week, frankly.
Yeah, and Amanda, that completely lines up with what we heard from Bostic yesterday. But again, that was bad news for bonds when we heard that. Luke, if that's the drip feed we're going to get, and we're going to get into the central bank speak in a little bit, I know you like duration. You want to add, I mean, is this not a tough environment to be buying duration in if we're going to continue to get these blips and bumps along the way of inflation scares?
It's never easy when we come off such a big inflationary environment. I think we are getting to a point of more stable inflation and lower inflation. I think the Fed will move in this half of the year rather than the next half of the year. But ultimately, it won't matter. I think we have to use these pullbacks to add duration, almost dollar cost averaging into your US Treasury portfolio. It's definitely not have no duration and add loads. It's a step by step by step by step. We're getting there. The Fed will get there too. Inflation will get there. And I think we'll all be in a good place by the end of the year.
Well, I'll tell you what, it's not that folks are adding duration right now. It's that they're adding risk. It's not even just stocks. It is remarkable to see what's happened to the credit market over the past week. Demand is insatiable. And on this, Bank of America is screaming bubble. They say nothing screams bubbly markets more than when corporate bonds start heading for the stratosphere. Amanda, they're basically saying that we're lurching from bubble to bubble, and the latest one is seen in incredibly tight spreads. Does this end in tears?
We don't see a bubble in the credit markets. And in fact, we have a pretty constructive view on credit risk here. I think one of the really important factors to keep in mind is that this backup in yields when and during the periods of time that we see it provides an opportunity for yield-based buyers to deploy capital at fairly attractive all-in yields. And so that in general has actually brought out a fair amount of demand from certain investor cohorts, even while spreads are somewhat snug on a historical basis. And on that spread point, actually, if you look just even back to mid-2021, there is a fair amount of scope for spreads to tighten even more. It sounds maybe a bit counterintuitive to say, but when you look at the index, even if you adjust it for dollar price and duration, we've been tighter than this not that long ago. The key will be, do we have a supportive growth inflation mix, and do we have a central bank in the Fed that is willing to cut rates proactively? But I don't view it as a hindrance for investors to put money to work in corporate credit. In fact, I think it's actually just the opposite. And what we've seen has been relative resilience in corporates' ability to navigate this higher cost of capital environment. That's true in public credit as well as in private debt. So I don't actually think that it's too much of a headwind. I think we have to pay attention to some of the nuances, and that maybe spreads look optically tight, but in reality, there are some nuances there where they could actually move tighter.
Right. Well, it certainly tells us, if anything, that there's a lot of liquidity sloshing around in the system. Luke, what do you think the impact of that exactly is?
Well, you've got two credit investors on stage, but I don't agree at all. I think that liquidity is entirely what's been driving credit spreads tighter. It's not a change in the fundamentals. It's not the better background. It's not the cutting of interest rates or inflation. It's a massive amount of liquidity. The support for new deals, even in just the last week, has been extraordinary. And whether those deals are coming from corporates, banks, or governments, the amount of money that's sloshing into it is massive. Even Bitcoin ETF is taking money left, right, and centre. So whilst that continues, yes, credit spreads will continue to grind tighter, but it's going to get harder and harder and harder to see much of an impact from capital gains from credit getting tighter, and it becomes more of a carry story that you're just trying to get that incremental little bit of income, which is fine as long as everything stays stable. And that's the risk investors face. As you get tighter in credit spreads, you should be reducing your risk to them. That has always been the case, and I think it's probably the same now.
Well, some healthy disagreement. That's exactly what makes a market, and a market is going to be made next week with more Fed speak. We were talking about already hearing from Atlanta Fed President Raphael Bostic. I want to hear from the man himself. Here's what he had to say.
The evidence from data, our surveys, and our outreach says that victory is not clearly in hand, and leaves me not yet comfortable that inflation is inexorably declining to our 2% objective. And that may be true for some time, even if the January Consumer Price Index report turns out to be an aberration.
Let's bring in Michael McKee to add to this conversation. Mike, we had Barkin speaking about an hour ago. Barr, I think, is speaking shortly, if not now. Daly speaks at noon, not to mention everything we're going to get next week. Do you expect the tone to sound a bit more like Bostic after this week's data?
I think so. I mean, what Raphael was able to do was tie in the data that we have gotten. Previous speakers from the Fed last week and this week have suggested also that they're ready to wait. I would add to his list of possible reasons for caution this Bloomberg chart. It shows what's happened with both CPI and PPI. They've come up a little bit, and on a year-over-year basis, the core numbers are flat. The progress we had seen halted, and of course, with retail sales on the bottom there, you can see that we went the other direction. Now, there may be excuses for all that, so we're going to have to continue to watch additional data, and next week we do get significant data. We'll get the Fed minutes. Now, that'll be 3 weeks old, but it may eliminate some of what they're thinking about in terms of what they want to see before they cut. Other than that, not a whole lot, except the income spending and the PCE inflation numbers, which is their index. Omar Sharif of Inflation Insights says the PPI today may push the month-over-month gain in the PCE to 0.4. That would be double last month and double expectations, and would not be good news for the idea of rate cuts. Who is going to be talking? Well, we got a whole host, 9 members of the Open Market Committee in the next 2 weeks before we get to the end of the month. The question is, will they say anything different, and will the markets really have something to move on when they are talking? I think they may not, and here's the reason why. We get Jay Powell. Yesterday it was announced he will give his semi-annual Humphrey Hawkins testimony on May 6th and May 7th. So we may not get any kind of definitive answers till we get through all of that data, and then we hear from the chairman. Now, we know he's not going to say March is on the table, but is he going to push back against May? Tune in.
Mike, as I said, Barr is just starting to speak. We're getting some lines crossing. The Fed's Barr saying that supervisors are closely focused on bank CRE loans. He's saying that the Fed is asking if banks are doing enough to brace for bad loans. Regulators have downgraded bank ratings at a faster pace. Mike, amid all of this, amid all the inflation, they are still focused on banks. It makes sense, of course, that Barr is. How much does that confuse their job going forward?
When you talk to them and when they talk in public, they're saying the banking system is sound and resilient. And Vice Chairman Barr's speech today is basically a look back at what happened with SVB and an outline of what the Fed has done since then. They've cracked down on some of the banks, and they've tightened their supervision, and they're trying to make sure that nobody gets as far offside as SVB did. At this point, their argument is nobody is in that kind of position. Of course, it's always what you don't know that matters.
Mike, thanks so much. That's Michael McKee. And Luke Hickmore and Amanda Lynham are still with us. Amanda, I have to follow up on these Barr lines, saying that they're still closely focused on bank CRE loans. Have we seen the worst? Is it past us yet?
It's a great point, Dani. So CRE, in our view, is a highly dispersed asset class. The office sector has been in the headlines, of course, well telegraphed structural shifts there. But there are also other parts of CRE that are doing quite well. So that's certain subsets of industrial and self-storage and hotels, even some parts of multifamily. So that is a sector that we don't approach with a broad brush. I think the one takeaway that we do feel pretty confident about is that this is going to be a longer-term process. In years past, and even in the experience following the financial crisis, which we're not at all making a distinction that we're in a similar environment, but in the financial crisis, that long-term kind of loss and default cycle and right-sizing of valuations took years. We expect a similar pattern to prevail this time around, just given some of the long-term nature of office leases, the fact that we need transactions to rebound in order to reset valuations. That's not going to be as quick of a process as you see, for example, in the corporate credit market when there's a default and that process moves much more in a speedy direction. So it's something that we think will be in the background for a while. I think the key for corporate credit investors is, does this remain, as Chair Powell and Secretary Yellen have recently said publicly, manageable and idiosyncratic to a group of banks, or does it become a widespread issue? It's not our base case that this becomes a widespread or systemic issue, but I do think that we should expect that price discovery process to continue. Unlike the credit market, where M&A strategic volumes have increased, we have not seen CRE volumes increase to the same extent, and so that will be a necessary ingredient for valuations to reset.
Right now, markets selling off small caps, which of course includes those regional banks, probably do more to the PPI than those lines from Barr. Luke, Amanda, stick with us. That's Luke Hickmore and Amanda Lynham. Joining us now to take a look at some of the stocks moving ahead of the opening bell is Abigail Doolittle. Abby.
Well, Dani, it's interesting because we have the U.S. futures, the S&P 500 futures down ever so slightly, but bigger movers beneath the surface. Starting off with the shares of Coinbase, this stock is surging. The crypto exchange made a surprise return to not just profitability, but robust profitability. They put up $1 for an adjusted earnings versus the estimate of a penny. Sales were 15% better than expected. Jefferies is saying that the surge in retail is behind it. Others saying crypto crypto prices. Either way, there is a 10% short interest, so some of this could be a squeeze. Super microcomputer up 7% in the pre-market, heading to a potential 10th up day in a row. That would be the longest winning streak, at least since 2016, a record high going back all the way to 2007. Bank of America yesterday coming out and saying that even after the stock rose 900%, it can go higher yet. The RSI is extremely extended. FOMO, but the stock really is higher. And then Nike, not so much, down 1.2%. They're cutting 2% of their workforce. That should amount to about 1,600 people to save money. This as growing consumer concerns is weighing on sales, Dani.
Yeah, but you look at some of those good earnings, and perhaps that's why the overall index isn't doing as bad as you think it might after hot data. Abby, thank you so much. Coming up on the show, another day, another round of layoffs.
There absolutely are pockets of weakness out there. Look at the job losses, the miscellaneous job losses being announced practically on a constant basis every day. We're seeing little trickles.
Nike, just the latest, announcing it will cut 2% of its workforce. We're going to have more on the retail landscape next. This is Bloomberg.
There absolutely are pockets of weakness out there. Look at the job losses, the miscellaneous job losses being announced practically on a constant basis every day. We're seeing little trickles. But then you get payrolls of 353, and you get 0.4% core, and you realize, well, the economy is still pretty hot.
The narrative of a resilient U.S. economy is being clouded by more and more layoffs. The latest job cuts coming to Nike, slashing 2% of its workforce, and writing in a statement, quote, "The actions put us in position to right-size our organization and go after our biggest growth opportunities." The latest developments set the stage for the next 2 weeks. We're going to get big box retailers starting to pump out quarterly results. Let's learn about it. Now we're joined by Bloomberg's Simone Foxman. Hi, Simone.
Hi, Dani. Yeah, so at the end, in its annual report, Nike said it employed about 84,000 people. Though it didn't name numbers in its statement yesterday, this is likely to affect about 1,700 people. These layoffs are going to begin on Friday and likely to last through the end of its second quarter in May. This really signifying some near-term struggles for the company. Weaker sales, growing competition, especially in its sportswear brands. Oppenheimer cutting its price target to $110 a share from $150 a share and downgrading to a perform rating, saying there's not a quick fix to Nike's overall problems and looking for more sustained fundamental growth. But really, retailers have been all over the place. Home Depot, Walmart, yes, kicking off earnings for those big box next week. They've underperformed the market over the past year, but many of them are really hot on analysts' lists. In fact, there are no sell ratings for Walmart. We're looking for sustained same-store sales growth of about 3%, whereas Home Depot, the goal there is really to keep those same-store sales declines amid high interest rates and slowing building to about negative 3.6%. But some of the data that we're getting shows what Citi calls a really shaky start to 2024. That is going to be the key on analyst minds as they listen to some of these earnings calls starting next Tuesday with Home Depot and Walmart, Dani.
Simone, appreciate it. Bloomberg's Simone Foxman and Luke Hickmore and Amanda Lynham are still back with us. Luke, it is this drip feed. First it was the tech companies, now it is Nike. It does feel like a shift that companies are finally willing to let employees go. It's not the hoarding we knew of last year, but it doesn't seem to be filtering through to the headline level. What do you make of that?
It's difficult to square off, isn't it? The Fed Beige Book also pointed at pockets of weakness coming through in all of this. And I guess if you've been putting wages up during 2022 and 23, which Nike almost certainly will have been doing, and a lot of people will have been doing, that's a nominal increase as well. And it stays there as inflation falls off and actually nominal growth falls off. You have to adjust your cost base for the new reality that we're in. And we're going to see it again and again and again. And I think that the problem with all of the unemployment and employment numbers is they could be so survey evidenced that actually the reality could take a little bit longer to come through. Maybe we're seeing that. But it's hard to fight against the moves that we have seen in non-farms.
Yeah, it's true. And Amanda, only a minute here, but do you expect some of these incremental moves from tech, from Nike to filter through at some point?
I think our base case is absolutely for an ongoing rebalancing in the labor market. But with the unemployment rate under 4% for close to 2 years and the jobs workers gap still skewing in terms of more demand than labor supply, I think for now it doesn't pose a significant downside risk to the economy. But I would expect an ongoing rebalancing as almost a necessary ingredient to cool some of that services inflation that we and market participants and presumably the Fed are very closely watching.
Luke, again, very quickly here, but does this also mean margin compression it is in and it is happening for companies if they're looking at cutting costs this way?
Yeah, it has to be. It has to be margin compression. You have to get on top of your costs in the environment we're in. Slow growth, lower nominal growth, cost.
Fair enough. That was very succinct, Luke. Appreciate it. That is Luke Hickmore and Amanda Linum. We are seeing continuing selling off in these markets. The Russell 2000 down 1.5% after that hotter PPI data. The rest of this equity market, tech is even able to move higher, up about 0.1%. Well, coming up, we're going to get your morning calls. And later, we're going to be talking with Talbakin's Michael Purvis on big tech's moment of truth. We have NVIDIA earnings hitting the tape next week. Will NVIDIA save us all after too hot inflation data? That conversation is coming up shortly. This is Bloomberg. U.S. PPI comes in at 0.9% year over year, estimate for 0.6. It is enough to pull equities back, at least this future session, from their highs of the year. We hit that record yet again yesterday. We're down by about 1/10. It's not a lot of drama. It's not too bad, but it is lower. Tech, though, that outperforms up 1/10. Maybe it's the solid earnings, Coinbase, Applied Materials, those hanging in. Finally, Russell 2000 futures. Here's the drama, if you want to find some. Down 1 1/3, matching some of the backup in rates that we're also seeing. The small caps, they want cuts. It doesn't seem like we're getting it. All right, time now for your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Oppenheimer downgrades Nike. Market perform, worried about U.S. consumer and weakening demand trends. Next up, Baird upgrades UPS to outperform, highlighting the stock's favorable risk-reward. Finally, Raymond James downgrades Carvana to underperform, expecting limited upside following the stock's recent outperformance. Coming up, we have to brace ourselves for NVIDIA. Will the earnings on Wednesday make or break the rally in big tech? You saw it there. Tech seems not to be impacted by the hotter data. Futures in the NASDAQ up by 0.1%. We're going to have that conversation up next with Talbakin's Michael Purvis. This is Bloomberg. Difference a day makes. We were euphoric on weaker retail sales yesterday. Today it is a concentration on too hot PPI. The opening bell is now. You're looking at futures slightly lower. Not too bad in tech. Outperformance. Are we still impervious to hotter PPI, to hotter CPI? Russell 2000 futures certainly aren't. We're down 1.2%. The drama perhaps is in yields. Let me show you what this bond market is doing, because at least for the front end of the curve, we are up higher at the highest level for this year in rates. The 10-year yield backs off the worst of the losses we've seen. Yields are up about 8.5 basis points. NY crude adds on to yesterday's gain of 1.5%. We're up 0.5%, just under $79 a barrel. Euro weakens versus the dollar. It is that hot data that's sending the dollar higher. It's a repeat of Wednesday, folks, when that CPI data sent the euro to year-to-date lows. We're staring down the same. 107 is where we stand. Now, one stock to watch at this open, it is Nike. They're implementing new cost control measures, reducing its workforce by 2% amid growing competition. Bloomberg's Abigail Doolittle has more. Abby.
Well, Dani, let's start with this fact. This stock is down about 40% from its 2021 high. So clearly shareholders want something done. Management wants something done. Growth has dropped with that drop in the stock. I should actually say that the drop in growth has driven the drop in stock. Sales in the last fiscal year up 5% versus up 19% in 2021. From an earnings standpoint, it's even worse. Growth has been negative over the last 2 years versus up pretty solidly back in 2021. So they're talking about a super lumpy business. It even just shows up in the financials. They're also saying that they're seeing caution on the part of the consumer. So to your point, they're looking to cost cutting in terms of simplifying their own operations. In addition to that 2% cut of the workforce, or about 1,600 to 1,700 people, 2 waves. The first today, probably not an easy feeling for those more than 80,000 employees around the world. It could equal about $2 billion in savings. Oppenheimer, though, Dani, not so impressed. They have cut the stock to a perform from an outperform, saying there is no quote-unquote quick fix for Nike.
As Luke Hickmore was saying, the margin pressure it is in. Abigail, thank you so much. Now, other earnings, Roku shares are plunging after its first quarter profit fell short of analyst expectations. Bloomberg's Simone Foxman has more. Simone.
Yeah, the company reporting results after the bell yesterday, and the market really not impressed despite some positives here. Let me start with those. Fourth quarter EPS were in line with analyst expectations at a loss of 55 cents a share. And we got actually better than the street was expecting in terms of the revenue front, a 14% year-on-year growth at $984 million. Active customer accounts also up 14% year-on-year. But there was one data point that has been really troubling for analysts, and that is average revenue per user. That was under anticipated, and it was down 4.2% year on year, suggesting that ads just simply not as profitable as we get more competition in this online streaming space. Stevens saying Roku continues to call out an unfavorable macro environment in the near term, an uneven ad market recovery. Oppenheimer says it doesn't see the stock going anywhere until it gets sustainable high teens revenue growth. This has been a tough week for Roku as well, because Walmart, there were reports that Walmart may be buying Vizio. That means a potential expansion by Walmart as well into this ads and streaming space. Broadly, this stock is down over 80% from hitting a high in July 2021, and of course down nearly 20% today, Dani.
Yeah, that is painful, at its lowest since 2023. Simone, thanks for breaking it down. Now let's stick with earnings, because on the good side of things, we need some good news today. Shares of Applied Materials hit a fresh intraday record high after delivering a bullish outlook. Bloomberg's Isabel Lee joins us for more. Isabel, are the chip makers or the makers of the chip makers back?
They are back, and this is the much-needed good news. You're right. Shares are up around 8%, and it's really the bullish revenue forecast that got investors excited, because this means that some of the biggest semiconductor companies are increasing their investments in new products. That, and that the chip industry may just be bouncing back faster than expected. We have fiscal second quarter sales around $6.5 billion. That's higher than estimates. And excluding some items, profits will be $1.79 to $2.15. That's the average. That's the low end of the average projection. So Applied Materials supplies gear to a lot of the big sector's major manufacturers. That includes Samsung, Taiwan Semiconductor, and Intel, which is why this makes the company's projections an indicator of future confidence when it comes to key demands of the electronic supply chain. And we also have sales slipping, but still higher than expected. And China was a bright spot. We saw sales more than doubling and now accounting for 45% of the total of the company. And demand for chips has been growing because, as you know, more and more devices are becoming more complex and more complicated, and they demand now more computing capacity and the ability to sense the world around them. So that's one thing for those who are into high-tech stuff. For now, shares are up around 9%.
Who among us aren't into high-tech stuff? Isabel, appreciate it. Isabel Lee. Let's turn to the other tech stuff. Bloomberg is reporting that Apple is developing a new AI tool to compete with its rival Microsoft. Bloomberg's Ed Ludlow is in San Francisco. Ed, I feel like I woke up to maybe 10 different headlines about different AI competition. What's Apple doing here?
Not very much, to be honest with you. If you look at the stock, we're higher 1/10 of 1%. By the way, I'm into that high-tech stuff.
Love it.
But this is an important report from Bloomberg's Mark Gurman, because Apple has not really shown its hand to the extent that Amazon, specifically Microsoft and Alphabet, have on consumer-facing AI tools. What he's reporting is that they're working on an add to Xcode, which is their program writing platform for app developers, where it will have a generative AI capability, something akin to Microsoft's GitHub Copilot. It's a predictive tool where if you're writing code, you're a software engineer, it helps you complete that code. It's basically more time efficient. It's a very useful tool to have. And what sources are telling us is that within Apple, having presented some of the work that they did on AI to the board at the end of last year, they're doing what's called dog fooding, which is using all of these AI tools internally before a wider rollout to third-party developers. So this isn't kind of the sexy generative AI ChatGPT tool that a consumer can get their hands on immediately. But the other side of the coin is Apple's always been flexing that it is kind of focused on machine learning and has been for a long time. All the other names out there, I point you towards Alphabet, parent of Google. It's softer by 1% now, a really big decline Thursday. The Information reported that OpenAI is working on its own search, powered by Microsoft's Bing, and that seemed to have a substantive and direct causal effect on Alphabet shares, though every investor that I speak to says, don't do anything knee-jerk. It's going to take something very significant to knock Alphabet or Google off the search perch. God, that's a lot for a Friday. Happy Friday, Dani.
Happy Friday, Ed. And we love an underdog story. Justice for Bing. Ed, thanks so much. And you might have seen at the bottom of your screen there, Super Microcomputer still up 7% today. Tune in to Ed's interview with the CEO of the company. That is at 11 a.m. Eastern. Now let's stick with tech because it's the one everybody's waiting for. NVIDIA results sparked a monster rally in big tech last year, and that has investors bracing for yet another critical report next week. Take a listen.
I do think the sky's the limit. This is the third time in my career, I'm now 45, where I think I've seen something that is going to have a before and after epochal change. So internet, CRISPR, and now AI. I think that the AI movement will have at least as big an economic GDP impact as the internet has, maybe greater. And so does that translate into an ever-growing stock price? That I can't say.
The sky's the limit. The hype is ever real. Let's continue the conversation now with Telbacken's Michael Purvis. Michael, here we are in the world. It's all calm in the VIX. We've been under 20% for about 4 months. And then I look at the options buildup in NVIDIA with implied volatility on their earnings around 11%. Do I need to be thinking about Wednesday as not just NVIDIA earnings, but also a day of a potential volatility event?
Well, it's interesting you bring that up because there's even a bump in the SPX volatility for the, in other words, a premium for SPX options on the NVIDIA announcement. And I think it's a little bit of a metaphor for how important NVIDIA's earnings are for this overall trajectory of this stock market right now. One of the things I've certainly been very focused on is the how low correlation across stocks have been. And one way to think about that is just there's not a lot of macro priced into single stock options right now, which is arguably a sign of too much optimism, I think, at sort of creeping in. Ironically, it may be a single stock earnings release next week that if they do disappoint, or at least don't exceed expectations, that might be the actual kind of sort of quasi macro event that actually drives correlations across stocks higher. It's a very unusual condition but let's face it, NVIDIA was the anchor of the big tech rally last year, and big tech was the anchor of the broader stock market rally, and that continues to be the case this year. Valuations have been stretched. They've done a masterful job of producing earnings growth last year there, but if they at this stage, I think if they do underperform, it will be a volatility event, for the broader market.
Well, on that note, Michael, I was reading your note from earlier this week, and this stood out to me when you wrote that a variety of volatility metrics are eerily similar to January 2018, just before the manic VIX surge a couple of weeks later. We are not saying this will be happening this week or next week, but we are saying there is plenty of gunpowder and plenty of matches lying around close by. If you want to lose some sleep tonight, that's a good note for all of our viewers to read, Michael. I mean, could this be it? Could bad NVIDIA earnings be the match lit?
That's one of the potential catalysts. It could be more economic data that affirms that we're not going to get rate cuts anytime soon. Could be a geopolitical event. You just never really know. But what you do know on the sort of the gunpowder side, if you will, to torture this metaphor, is that there's been various facets of short volatility trades that have been working, that have been put on, and sort of it feels like an increasing scale there into a stock market that has done extraordinarily well. And so if you think back to the Volmageddon of February of 2018, that was when the XIV ETF, sort of a short VIX ETF, famously just blew up and yanked the VIX up from very low numbers to I think as high as 50. And of course, that rippled through to equities and gave everyone a little bit of agita, regardless of what you were investing in at the time there. And I think there's a lot of similarities between now. Like, if you look back at 2017, you had a strong rally. You had a lot of divergence led by tech in that year, same thing like last year, and so forth. If you look at implied correlations now, they're basically where they were back then there. And too much of a short volatility trade just at some point engenders a big volatility spike there. It doesn't mean that and it really doesn't have to be bad, anything bad fundamentally in the economy or anything like that. It could just be something that gets the market to say, wait a second, we're not going to keep buying this dip, realize volatility picks up, and then that triggers a bunch of closing out of short volatility trades. That process is inherently a convex process.
Right. Well, Michael, because I remember when that 2018 Volmageddon VIX blow-up happened, and at the time I'd spoke to a tiny little fund in Colorado that was going long volatility because they thought that would happen. They got something like an 8,600% profit, I think, on it. If you're saying the market structure is set up that way, should I be punting on that type of options trade, getting ready for an explosion in volatility?
Yeah, well, I think you've seen VIX call buying pick up over the last few weeks there, and I think that's certainly a trade I've been recommending to my clients earlier this year. I think if you look at the VIX, it's sort of cautiously making a series of higher lows and higher highs. They're nothing dramatic yet, but it feels like things are building here. And, it's funny, you look at basically economic conditions are good, earnings are reasonably good here. But let's face it, valuation has been stretched. I think it's important to remember that the stock market rally last year started with AI. It also started with a massive amounts of offsides positioning.
Right.
And, just for context, more than half of last year's 24% rally came in November and December. And I think a lot of this momentum you've seen carry over into January and February can still be explained a little bit by, some positioning catch-up
but Michael,
there.
I mean, can it be more than positioning? We only have a minute here, so I got to jump in. I mean, earnings have been good. The economic data, okay, hot, but not that bad. I mean, aren't things good enough to just continue the rally?
Absolutely. No, well, yes. Like, you can check all the boxes you'd want for in terms of a lot of the fundamentals and the momentum and so forth. And yes, and the rate, I do think rates are going to keep climbing higher here. And I don't think that has to be, the death knell in and of itself. But look, you can go through a lot of great bull trends against good economic and earnings backdrops, and you do see big volatility spikes here. I'm constructive on the broader market this year and on the broader economy, without question. There, but I think after such a sort of tireless rally, a relentless rally, it was such a smothering of correlations across stocks and a lot of evidence that this sort of short volatility trade has been put on. I think we should be bracing for something at some point soon. And again, it doesn't mean that the fundamentals suddenly are broken. It just means that there's too much too fast. And I think VIX calls are probably a better trade than SPY puts in that respect. I just think
another
there's better risk return.
would certainly be a way to wake us all up from our slumber. Michael, we're going to have to leave it there. Thanks for joining us. Michael Purvis of Telback & Capital Advisors. Coming up, Republicans talk tough as a government shutdown looms.
You're not going to get another continuing resolution out of our conference in Congress.
We'll get the latest on the budget talks or lack thereof next. This is Bloomberg.
You're not going to get another continuing resolution out of our conference in Congress. The last one was difficult, and that was done because our Speaker recognized that there just wasn't enough physical time to process all the bills once the House and the Senate had agreed on the top line numbers. So this time you're going to have to get these things passed.
Republican Representative Tom Emmer saying the House will not pass another stopgap spending bill by March 1st, the latest deadline for a partial government shutdown. The House is on recess until Feb 28th, and that leaves very little time for negotiations. Bloomberg's Anne-Marie Hordern joins us now. Anne-Marie, does this mean we're going to have to do the whole song and dance again?
Yeah, multiple times we've had to do this song and dance. But let's first say that what we heard from the majority whip there is that he's saying there's going to be no continuing resolution. We've also heard this in the past from Speaker Johnson, and then in the end, we've had continuing resolutions. What makes this so difficult is the timing. So the House has already left, as you mentioned, Dani. They left yesterday, and they're not back till the end of February 28th. And the first deadline for the first tranche of a government shutdown is March 1st, the second then coming March 8th. So there's a wide swath of the government they'd have to be able to fund by March 1st. So that gives them about 3 days to get it done. And that is why everyone is shrugging this off and saying, you're going to have to do some sort of continuing resolution, kick the can down the road, or we're going to end up in a government shutdown.
Anne-Marie, we also learned earlier this morning that Alexei Navalny, one of Putin's most outspoken critics who had been jailed since 2021, has died, according to the prison service. Does this change the conversation in D.C. at all?
I think it's a question of whether or not this puts more impetus on Congress to get that foreign aid bill done, because Ukraine is obviously one of the big winners in that aid bill. A number of weapons that would go through the U.S. industrial complex would then be shifted over to Ukraine. And what the White House's response is going to be, they're going to want to punish Putin for this. But already we see the Russian economy have a number of sanctions and penalties against this. We should note what Secretary Blinken had to say about this when he heard the news. He said for more than a decade, the Russian government and Putin personally persecuted, poisoned, and imprisoned Alexei Navalny. His death in a Russian prison and the fixation and fear of one man only underscores the weakness and rot at the heart of the system that Putin has built. Russia is responsible for this. That is the line from the administration.
It's very strong language, and yes, do they back that up with aid passed to Ukraine? Anne-Marie, thank you very much. That is Bloomberg's Anne-Marie Hordern. Okay, let's get you up to speed on some of the sector price action this morning. Let's get over to Bloomberg's Abigail Doolittle. Abby.
Well, we are, Dani, at this point taking a look at a very small decline for the S&P 500, down about 0.3%. Materials, the only sector higher, up 0.7%. So broad participation to the downside, led by real estate, down 1.2%. Communication services, down more than 1%. On the week, let's take a look at what is happening for the S&P 500 in terms of the top sectors and the bottom sectors. So two of the best sectors, energy and materials clearly getting a boost today for sure. And then on bottom, you can see that consumer discretionary down 1%. We also have tech down 1.8%. And that is the reason why we're looking at a decline, the first in a little while, Dani, of about 0.2%. So today's trading action is really going to decide whether or not we see a gain or a decline for the S&P 500.
Yeah, do we finally see the cracks in big tech after that hot figure? Abby, thanks so much. Abigail Doolittle there. Coming up, the market-moving events that you need to be watching for your Friday trading day. That's next in our trading diary. This is Bloomberg. Back from the CPI on Wednesday, but are we going to be able to bounce back from the hot PPI? Look at what tech is doing, down 0.8%. It is the Mag 7 that is getting hurt this morning. Meta down by 2.25%, but of course, Russell 2000. If we're not going to get cuts anytime soon, this thing gets clobbered, down by 1 1/3. Bond yields, those are backing up. Rates are moving higher this morning. Front end leading those declines. We're up about 8 basis points, trading just off the highs of the year. All right, time now for your trading diary. Here's what you need to be watching through this day and next week. The UMich Sentiment Survey comes at the top of the hour. Then San Francisco Fed President Mary Daly will speak shortly after noon Eastern. Next Monday, U.S. markets are closed for President's Day. Tuesday, we're going to get earnings from Walmart and Home Depot. finally on Wednesday, it's NVIDIA's turn to report. We were just speaking with Michael Purvis, who says that it could be a volatility event for this market if it disappoints, that there's so much option buildup around NVIDIA. If it goes wrong, brace yourselves for a Volmageddon 2.0. In the meantime, we are seeing volatility today. Your VIX is up about to 14.5%, still under 20, so nothing that consequential. But Mag 7 sells off again. That hit to Meta, pretty significant. All right, that does it for us here. That was the countdown to the open. This is Bloomberg.